Today, Matt Cochrane and I are reuniting to discuss another book. This one's The Big Short. On our last podcast, we talked about Liar's Poker, which was Michael Lewis's first book, which was about the bond market of the 1980s. And it's very much the prequel to The Big Short. It basically, you see a lot of the things that are set up in Liar's Poker eventually pay off 20 years later in The Big Short. So the story of The Big Short is it chronicles multiple investors who all identified the bubble in the real estate market and the fact that mortgage bonds had turned into trash, basically. And they all made a ton of money shorting the market at great stress and personal expense. It's also a movie, which I also think is a good movie that I'd recommend checking out, that came out 10 years ago, 2015. But yeah, I think this is a good topic to explore. It gets into a lot of what Wall Street is all about. I gets into a lot of how hard it is to be a contrarian for real, like not just say you're a contrarian, but actually go against the tide of how difficult that can be. But yeah, I'm looking forward to diving into this. So Matt, what did you think of the book?
Well, Value Stock Geek, once again, thank you so much for having me on. I always love these chats we do on books. And yeah, I think it's a great story of the great financial crisis and how behind the scenes some savvy investors like made a profit through all of that carnage. I really enjoyed this book. I more than most books we read, it was almost like a page turner. Like I got really into it. I try to time when we read these books. Like I try to time like I finish them like pretty soon, right before we record a podcast. And this one, I started it way too early because I just like went right through it because I was just eager to like keep reading. I love the movie based on this book. I think I told you that last time. Like it's to me, it's the best financial movie out there, but also called The Big Short. And like reading the book, I've seen the movie so many times. Like reading the books, I can't help but picture like when it's Michael Burry, like I picture Christian Bale, and I picture like Steve Carell when it's talking about Steve Eisman and so on. But yeah, I thought it was a fantastic book, and I'm excited to dive through this with you.
Yeah, I'm looking forward to it too. So the last podcast was Liar's Poker. So what were some of the relationships that you thought were similar between the two books? Like what kind of DNA do you think that they shared there?
I told you this last time. Like when I had never read Liar's Poker, and I didn't honestly, I just didn't know too much about it.
Hmm.
Where I never read The Big Short either, but I just seen the movie so many times, like I was at least familiar with the story. Like, but when I read Liar's Poker, like I had to check like when he wrote it because I was like, oh, he must have written this after the financial crisis and gone back and been like, look, these are relevant experiences now. But he didn't. I mean, he wrote that, but I think that was his first book that Michael Lewis ever wrote, and it was right after he left the investment banking world. But so much of it was like the seeds of the financial crisis were planted during Michael Lewis's time, the author of both these books as an investment banker, like when he was on Wall Street, and just the origin of the more creating, basically making mortgages and packaging them into different bonds so that investors could invest in them because they were considered safe, yield friendly, shareholder friendly investments. And just how that like completely spun out of control. I guess Liar's Poker is written in the 80s and kind of takes place in the mid 80s, in Wall
Hmm.
Street. And, it definitely, you see a lot of the excesses there on Wall Street. And then, but how 20, 25 years later, how that just all unravels in the financial crisis.
Absolutely. Yeah, I saw a very similar thing. Basically, like it's like a lot of the trends that started in the 80s. So you've got like the move from partnerships where the partner's capital is at stake to corporations. That starts with Solomon Brothers in the early 80s. You've got Louis Ranieri creates the first mortgage bonds and creates the market for it. And then basically by the 2000s, every major Wall Street bank is now a corporation. So the partner's capital isn't at stake anymore. And that changes the relationship with risk. And then on top of that, you have mortgage bonds, which start out as pretty good instruments, in my opinion. Like the original mortgage bonds were mostly highly rated mortgages, and they weren't gamed or anything. But then you fast forward 20 years and they've now been corrupted into this terrible product that will eventually kind of that will eventually blow up the world economy in 2008. So, yeah.
Yeah, no, 100%. Like mortgage bonds were a great financial product. Like,
Hmm.
speaking as a trustee on a pension fund, I mean, that's like something that, if done right, and that carries a lot of weight here, but like if done right, that's a great investment. There's pensions, retirees, a lot of people can probably fulfill some worthy financial goals by investing in mortgage bonds. Unfortunately, when you mess up the credit ratings on these bonds, and then like banks aren't incentivized anymore as partnerships, but the traders are incentivized as just a pure profit corporate, like it's all about like the corporate profits, like kind of machine. It got quickly out of control, right? And reading The Big Short, man, it's crazy how many people who were smart just did not understand like what they were investing in and what was really going on. And even like, I'm sure we'll get into this, but there's a guy at Morgan Stanley, it was like Hubler, like Howie Huber or something like that. And he understood that subprime mortgages were bad, and yet he was investing in what he thought was like the good mortgage bonds, the AAA rated mortgage bonds, and just for short-term profits to make his like profit book look good because he wanted to spin off into his own hedge fund. And there's so many players like that you see like they just don't understand what these subprime mortgage bonds that just blew up were really like made up of.
Yeah, absolutely. Yeah, and Howie Hubler, there's a chapter, yeah, there's basically one chapter devoted to him, and that's a very interesting story. He causes the largest loss for any Wall Street bank in history. I forget the exact dollar amount, but
About a gazillion dollars,
yeah, 1.5
right.
gazillion.
you know
Yeah, and it's crazy because he retires, a very wealthy man from the bonuses that he pulled in. And I think that's a good example of the partnership model getting screwed up, because you could get rich at these Wall Street banks if you deliver good short-term results. And, kind of it's like a damn long-term attitude. It's you're incentivized to just take huge risks early, bank your bonuses, make a ton of money, and if it blows up, well, okay, you get fired, but you've made a ton of money and can walk off into the sunset. It's a real crazy set of incentives.
Yeah, exactly. And so, like, if you're not familiar or you missed the episode about liar's poker, it's probably good to go back and listen to that episode. But like, what you're talking about, like, is that like so in Liar's Poker, the book that Michael Lewis first wrote, he works at the Salomon Brothers, and in the old days, like early '80s and before, like you worked at these investment firms, and the payoff, the golden parachute at the end of it was becoming a partner and then participating in that company's profits. Well, when these companies went public, that was all gone. And so it became all these traders were just incentivized to make a lot of money during the year so they would get a big bonus at the end of the year. And when they were incentivized to do that, they just slowly took on more and more risk during the year to try to like, so they could go, at their annual review and say, look how much profits I made this year. I deserve, this ridiculous bonus. And Lewis talks about it, and he's like, it was basically ridiculous. They really didn't know what they were doing. Like these bond traders, they didn't know what they were doing. They were young kids, and they were just like convincing people to buy things, convincing people to sell things, and just in and out of all these bond trades without really having the knowledge behind like trying to create all this trade flow traffic. But like that, so the incentives just got completely realigned. And so now you're not working long term to become a partner in this firm. You're just working for that year's bonus, and that's it. And when the incentives got misaligned, things kind of just snowballed and got out of control.
Yeah, absolutely. So what makes this book really compelling? Like, I think if it was just like the history of mortgage bonds and the bubble and how it blew up, that would be okay. That's a good book, but it's would be pretty boring. And I think what makes the book great is it finds great characters. So we've got these compelling characters and their personal story of how they're going along with it. And that's what I think turns the book into like a real page turner. So something I noticed is that basically the unifying theme of all of these characters is that for whatever reason, they have a deep cynicism and distrust of Wall Street and the financial system. So what did you think about that? Like, what do you think are some of the unifying characteristics of these people where they had, the gusto to go out and short a market that everybody thought was solid?
All right, first, you're absolutely right. This book is great. Well, one, if you're an investor, you love hearing about like stories about like how you found this great investment, right? I mean, like, to me, I think it's like when if you're a fisherman, like you love hearing stories about how somebody caught like a great catch. And if you're an investor, I think it's the same way. Like I love hearing stories. Like if somebody found a 100 bagger, I want to hear all about it. Like I can't get enough of that.
That's what makes it
So
fun, the hunt, the treasure hunt.
right,
Yeah.
right. So there's that aspect of it. And then the characters they find for this kind of trade, because they were betting like their whole funds, their whole portfolio. By the end of the book, the characters this follows is people who just became obsessed by this trade. Because the book mentions there's other people who made a similar trade, but it didn't like take over their portfolio. They weren't obsessed with it. They almost took it on as like a hedge, like if some other investments they had didn't work out. But the characters this book follows were just fantastic. So I think you have I guess how you wanted to define a main character, but you definitely had, so there's Steve Eisman, who if you've seen the movie, he's played by Steve Carell, and he kind of sees himself as like the champion of the underdog, right? Like that's just how he, I think, sees himself. Like he loved comic books, he loved superheroes, and he got his start on Wall Street, like covering banks. And so, I mean, this book starts off. I mean, this is just page 3, but like he was given sole responsibility for covering a company. He's an analyst at a Wall Street shop, and he's given the sole responsibility for covering a company called Lomas Financial Corporation, and it had just emerged from bankruptcy. And he puts a sell rating on it, and he goes, "I put a sell rating on the thing because it was a piece of shit. I didn't know that you weren't supposed to put sell ratings on companies. I thought there were 3 boxes: buy, hold, sell, and you could pick the one you thought you should." And he's talking about like this report he wrote on it. And he goes, "The single greatest line I ever wrote as an analyst," says Eisman, "was after Lomas Financial said they were hedged." And he's talking to Michael Lewis. He recited the line from memory. "The Lomas Financial Corporation is a perfectly hedged financial institution. It loses money in every conceivable interest rate environment." He goes, "I enjoyed writing that sentence more than any sentence I ever wrote." So, and then one of his friends is describing him. He goes, of Steve Eisman, he goes, "He's sort of a prick in a way, but he's smart and honest and fearless." So I think all these guys are in a way kind of socially awkward.
Hmm.
They have that like personality, or, like lack of social awareness, maybe in certain ways. And so Steve Eisman, he sees himself as a champion of the underdog. So he sees these banks, and he hates how like they take advantage of the customers, because this is the sector he's covering. So he hates like overdraft fees, and how the bank doesn't tell you right away, but like you can rack up lots of overdraft fees before you finally get a notification from your bank that you had the first overdraft fee. And he hates how like, and in his mind, and I'm not saying he's all right or all wrong. I'm just saying I think in his mind the financial crisis was all caused by the banks like giving these like homeowners or prospective homeowners like just completely irresponsible loans. Like, so like, like if you're without income verification and without like a good credit check, or without all these things, like they would just say, "Oh sure, you're pre-approved for a $500,000 mortgage," even if you're making $35,000 on a teacher salary, or something like that. And so in his mind, like these banks are like, they caused the crisis, and he just thought the banks were just preying on their customers and ripping them off. And so he in his mind, I think a lot of it was just, I'm sticking up for the underdog here. I'm a people's champion.
Yeah, absolutely. And you're right about they're all kind of like outsiders. Like there's no one here who took like your traditional like Wall Street path. Like they went for work for a big bank and then worked their way up to an investment banker or something. Like they all kind of come from a different perspective, which I think helps them see what's actually happening. And Steve Eisman is a super interesting character. So It's funny what you mentioned about the ratings because, like, on Wall Street, what they're doing is they're giving out ratings, but they don't want to piss those people off because they want to do deals with them. So no one gives sell ratings. And he was like, well, I should just say what I think. And he kind of reminds me of like Larry David and Curb Your Enthusiasm. If you've ever seen that show, where he has
Yeah,
like no filter and just says whatever is on his mind, he just tells the truth. Um,
right.
so that's Eisman. And a big thing that colored his experience was covering the subprime industry in the 1990s, where
Right.
he basically saw the way that this whole industry just screws over poor people. Like they put them in loans they can't afford. They exploit them with things like overdraft fees and stuff like that. And he sees basically the same thing happening at a bigger level in the 2000s with these mortgages.
So should we introduce all the characters, or should we stick with Eisman and then move on? How do you
Let,
want to tackle this here?
let's talk about them like one at a time. So we've got
All
Eisman,
right.
Bury, and Cornwall Capital are kind
All
of the
right.
big ones. So
So
yeah, let's talk about Eisman a little bit.
Eisman loved the idea of shorting banks. So he goes, this is how he put it. He goes, so he's talking about this guy like Greg Lippman, and he kind of introduced the idea of you can basically short the mortgage bond market. And he goes, when he walked in and said, you can make money shorting subprime paper, it was like putting a naked supermodel in front of me, said Eisman. What I couldn't understand was why he wanted me to do it. So, like, this guy Greg Lippman, he works at a Wall Street bank, and we'll talk about Michael Burry in a second. But Lippman's kind of like this character behind the scenes in the book.
Hmm.
Like he keeps showing up. He's all over the place, but like it doesn't follow his story quite as much as like these other players. But like I think he's played by Ryan Gosling in the movie. But like
Yes.
he's a very slick Wall Street person, salesperson, bond salesperson, and like Steve Eisman's hedge fund, they didn't trust him. They're like, this is exactly the type of guy like we can't trust. But they loved the idea so much that they couldn't help themselves. Like Eisman said, it's like putting a naked supermodel in front of me. So yeah, so like then, as you mentioned, like the Steve Eisman, like so they're shorting the mortgage bond market, and they realize like so these mortgage bonds they're getting AAA ratings,
Hmm.
and they don't understand why. They're like I think that was like one of the things that was the one. I think like these other players that we mentioned, like Huber and everyone else, I think they got tricked because they just accepted these credit ratings as gold, and they never looked further than that. It's AAA rated, then there's no credit default risk here. It's all good. But what they were doing, we should probably, I'm trying to follow Eisman's story, but just real quick, like what the mortgage ratings were doing. Like I thought the book covered this really well.
Yeah.
Well, they go,
Well, yeah, Littman guides them into basically how corrupt the whole system is. And he's like, look, you guys have way too much faith in this crap. Like Moody's is just basically doing the whims of the banks. They were gaming the credit ratings. So they were like putting enough high scores in there to dilute the average and obscure the fact that these were all like awful credit scores from people with no money. They were like ninja loans and stuff like that, like no income, no job, no assets. Yeah, so they like basically gamed Wall Street, gamed Moody's, and Moody's didn't want to upset Wall Street because they wanted to keep getting new deals, basically.
yeah, absolutely. And there was almost like this idea at the rating agencies, like there's safety and diversification, right? Like I think
Mm-hmm.
that's the best way I can describe it without like reading like a couple pages from the book. But like basically they're like, look, okay, all these homeowners, like if we find this average, and their magic number was if they have an average FICO score of 615
Mm-hmm.
in this like mortgage bond, right? So mortgage bonds made up of thousands of different mortgages, and if these homeowners have an average FICO score of 615, it's going to be good. It'll be okay. And so what they would do though, they were finding people with like 550 scores and matching them with like people with like higher scores to kind of get this average, which was
Mm-hmm.
like obviously like in retrospect, obviously just this horrible idea. And on top of that, they had something called like thick FICO scores and thin FICO scores,
Mm.
meaning that if somebody had like one credit card with like $200 of credit on it and they had paid it off on time, they might have like kind of almost this artificially high FICO score, even though they didn't have much of a credit history. Whereas someone who's like a 55-year-old homeowner and has been making like, paid all their bills on time for the last 30 years and an extensive credit history, they might have the same credit score. But there's obviously those credit scores are obviously very, very different if you
Hmm.
look just behind the number. And so they were taking these thin FICO scores and averaging them with people with bad credit scores, and they were like coming up with their average of 615, and they said this is safe. This is safe because what could possibly happen that would affect all these homeowners from California to Florida to New England, and like what kind of economic pressure could possibly happen that would affect all of them at once? They just didn't see it coming. They lacked the imagination, and they got like loosey goosey with their risk ratings. So they were giving these what should have been very bad credit ratings on these mortgage bonds. They were giving them very good scores.
Yeah, absolutely. That's exactly what happened. And it's interesting. Like, I often wonder, like, do you think that the banks knew that these products were total garbage, or did they just not care, or were they stupid, or like, what do you think they were? What do you think the end game was that they thought was going on here?
I think they were incentivized to be dumb,
Yeah.
right? So, like it talks about early in the book, like I forget the name of the financial institution that did it, but like Long Beach Savings. It was the first existing bank to adopt what was called the originate and sell model. And so now this happens all the time, right? Right?
Hmm.
Like so if you hold a mortgage, like there's a very, very good chance that like if you can make it online with Rocket Mortgage or Loan Depot, or there's these huge like partners. Or you could go to a traditional bank too, but there's a very good chance that like the whoever you used to take out your mortgage, like almost immediately, like in my case, I'll tell you, like I took out a mortgage, and within a couple months they had already sold it to another bank. And what that first bank is doing, like, and it's their business model, is like they're originating the mortgage, they find me as a customer, they make sure I have a good credit score or whatever, and then they take that loan and they sell it to someone else. Because that first bank, they're not in the business of like holding it for 30 years. This isn't like the 1980s model of your local neighborhood bank makes, more mortgage loans in this neighborhood because they understand the neighborhood well. A lot of it's online now, and this started like right around this time. So this new business model, I think it was like a business model out of nowhere, but like they would, like a bank would originate a mortgage and then sell the loan to whoever. And then that was put in a bond and so forth, right? Like these mortgages were packaged somewhere and put in a bond. So I think they were kind of incentivized to be dumb. And I think like, there was a lot of misplaced trust all along, up and down the whole business vertical, right? I think there was a lot of trust in the banks that were originating it, but like their incentive was just to originate as many loans as possible because they didn't end up holding the loan. So they, I think at the end they didn't care anymore, like how good of credit these homeowners had. They made the mortgage and sold it to a big investment bank that was going to package it into a mortgage bond. There was no skin off their back. They had nothing to lose from that because they were just selling more and more mortgages, and that's how they were making all their money from the transaction fees. And the investment banks weren't making the mortgage. I just think they had a lot of misplaced trust. Like the thinking at the time, I think was like, well, everybody pays their mortgage, right? Home prices only go up, and everybody pays their mortgage. So like, I
Hmm.
think those two things were like, instead of like home prices go up a lot and most people pay their mortgages most of the time, like by making those like those maxims, like just like, oh, all home prices always go up and they always go up by a lot, and everybody always pays their mortgage on time. I think those things like kind of misguided the whole industry.
Yeah, I think it's kind of like they were looking at it at maybe too of a micro level. Like they're saying, like, okay, well, who cares? I'm going to make a ton of money when I underwrite this thing, and then I'm going to unload it off of my balance sheet. So who cares? But without realizing that basically they were planting bombs all over the entire financial world that would eventually blow up, and that would eventually blow back and affect them. Like they didn't realize that the macro consequences of what they were doing at such a big level. They were just kind of looking at it like, well, this is one bond. I'm making X amount of dollars off of it. I'm going to throw it away. But yeah, I just don't think they were thinking like in bigger terms about what was happening. And the incentives, you're right, have a ton to do with it. And that ties into what we were talking about with the partnerships and that whole thing.
Absolutely. So going back to Eisman, sorry.
Yeah.
Like, I know we get sidetracked a lot.
Yeah. That's fine.
But like he's visiting the credit rating agencies, right? And he's like talking about like
Yes.
Moody's and S&P, and they just like they couldn't figure out why. And they're talking to somebody at S&P named Ernestine Warner, and she was an analyst, and so they're just questioning her, like, the loans were going bad, but the bonds weren't being downgraded. And so once again, Eisman wondered if S&P knew something he did not. So this is like something very, I think, very common if you're an investor. Like if you're making a contrarian bet, like, the market doesn't care when you buy it, right? You usually have to wait for that period when the market realizes that the investment you've made is correct. And so Eisman makes this big bet against the housing market, but like the prices weren't doing what they thought they should be doing based on like how subprime, defaults were going up and everything else. But the insurance that they had bought on all these mortgage bonds, the price was still like not reflecting the economic reality. And he goes, when we shorted the bonds, all we had was the pool level data, he said. The pool level data gave you the general characteristics, the average FICO scores, the average loan to value ratios, the average number of no doc loans. So, like, you could get a mortgage without showing any documents, and so forth. The one likely to go bad or the ones less likely to. It was impossible to determine how badly the Wall Street firms had gamed the system.
Hmm.
We, of course, thought that the ratings agencies had more data than we had, said Eisman. They didn't. And so they're like, well, they're asking them for like the information they have that they're using to make these AAA rating bonds, and they didn't have more information. And he goes, this was insane. The arbiter of the value of the bonds lacked access to relevant information about the bonds. When we asked her why, said Vinny, that's somebody who worked for Steve Eisman,
Hmm.
she said, the issuers won't give it to us. That's when I lost it. You need to demand to get it. She looked at us like, we can't do that. We were like, who's in charge here? You're the grown up. You're the cop. Tell them to fucking give it to you. Eisman concluded that S&P was worried that if they demanded the data from Wall Street would just go to Moody's for their ratings. So they basically, like, if they don't give the customer, the big banks, the rating they want, they'll just go to another credit rating agency.
Yeah, absolutely. Yeah, it was a warped sense of incentives, and the ratings agencies were complicit in the whole thing. Yeah, yeah, super crazy that ever happened. Yeah, and they also get into how people at the ratings agencies don't really stick around too long because it's ultimately like a feeder system into the banks. Yeah, so it also kind of made me think a lot. This whole thing really made me think about the moats of the ratings agencies. Because, like, if they could survive this thing, then I mean, what can ever do them under?
Well, yes, and I own Moody's right now.
Yeah,
Full disclosure, and I think I agree with you. I think S&P and Moody's probably have two of the biggest, widest economic moats you can have as a public company, and they're the villains in this story. Like, I
yeah,
mean, there's a lot of incompetent people in this story. There's a lot of losers. There's a lot of winners. But like the rating agencies, they're definitely in the category of the villains, and they just played they didn't do their job. They were supposed to be the cop, and the captain of the ship, and they were asleep at the wheel.
absolutely. So the next big character in the book is Michael Burry. So, he was like in the movie, they don't really get into his backstory, but the book really gets into it. And I think his backstory is totally fascinating. So he had one eye, and that led to some social ostracism. He had Asperger's, which he finds out as an adult later on in the book, and that contributed to his intense like focus on this topic, his ability to do these things. Like, he actually was able to go through he was probably the only person who actually went through the mortgage bond and systematically, I don't even think the people who underwrote it did, and went through each loan one by one to see what it was like. So he's a very unusual character. He was a value investor, and he had like $40,000, and he started a basically an early version of a blog. It wasn't even called a blog yet. This is in the late 90s. And he starts posting his stock picks while he's a medical student, and he's doing all of this at night, and he's just totally fascinated with this topic. And eventually he gives up on the medical thing, He's seeded with capital from Joel Greenblatt, legendary value investor. And he's known for just digging into companies at a level that most people, including professional investors, don't even get into. And he's posting incredible returns as a value investor in a time in the late 90s when value investing is very out of favor, and he's delivering incredible results. And then he stumbles upon this whole situation in the mortgage bond industry. So, yeah. So what did you think of Michael Burry? What did you think of him as his story and him as a character?
Yeah, so I think so in contrast, so Steve Eisman, they're based. He has a hedge fund. They're based in New York. They're going around. They're going to flying to Vegas for a conference to listen to these, the mortgage bond like conference. They send their analysts to like Florida to look at this neighborhood, like if the mortgages were really going bad. They're talking to the mortgage ratings agencies. They're doing all this kind of like what you would call like what I think you and I would call like good due diligence. And Michael Burry's just like burrowed in his office, and he like takes the mortgage bond and he actually just like goes through it and reads like what are the mortgages here? How many are 30 days past late? Going through thousands and thousands of mortgages. And it's like it's almost insane, right? I mean, like to that level. I love how the book describes him. So before this, like how he's a value investor, and it goes, often as not, he turned up what he called IC investments. In October 2001, he explained the concept in his letter to investors. IC investing means taking a special analytical interest in stocks that inspire a first reaction of ick. And it talks about like, it gives an example of that. And he's like Googling for fraud and like, companies that like executives would go to jail. And he turns up this like company where like the Chinese, it's called Avant, and there's like they stole like competitor software code that was the whole foundation of Avant's business. The executives go to jail, and he started buying this company at $12 a share. It goes all the way down to $2 a share. He's buying it all the way down because he's like, well, the core business is still there, and what they're going to pay and the lawsuit isn't that much. And he makes a killing in it, right? He goes from like $12 to $2, but then it goes to like $30 or something like that. But I
Mm-hmm.
mean, when you're talking about like real cigar butt businesses, I mean, and I love how it just describes it as ick,
Yeah.
like yeah, like companies like I would never ever invest in.
Yeah, he's a true deep value investor. You buy them when they're deeply out of favor, and then usually something happens and you get an extraordinary return out of it. And he's the best at it. He's the best. He's the best investor. There's actually a great Word document on the internet where he talks about like when he was a stock picker, and he talks about his process, which is super interesting. He talks about the whole idea of ick investing, of finding companies when they're deeply out of favor, buying them, and then selling them when they're polished up a little bit. That's how he describes it. I'll find that and link to it in the show notes.
He's talking about Avant, and he goes, Avant still makes me feel like I'm sleeping with the village slut. No matter how well my needs are met, I doubt I'll ever brag about it. The creep factor is off the charts. Like, the book does a great job of finding these really colorful characters,
Absolutely. So the other interesting thing about Michael Burry is that he basically invents the product that all of these guys wind up investing in. So he's like, I know that these mortgage bonds are terrible. I don't have a way to short them, but maybe basically I could use this other product called a credit default swap, which is used in other bonds. And basically, just for the listeners, what a credit default swap is, it's basically like insurance on a financial product. It's saying that like, I'm going to pay you premiums, and if it goes kaput, I get a huge sum of money. And that's really what it is. It's an insurance product. Banks would use it when they issued bonds to corporations, and they thought it was like a bad bond, but they didn't want to disrupt the relationship with that client. So they created this basically insurance product. Michael Burry learns about it, and he's like, well, I could apply this to mortgage bonds, and boom, now I have my way to short the market. So he goes to the banks and he proposes this product to them, and he basically invents it himself. And then all the other characters in the book are eventually buying into this product. But I thought that was amazing that like he basically thought up a new financial instrument to do the trade he wanted to do, and then had the banks create the product for him, uh,
And
which is
he did
pretty
it.
amazing.
And he was like a genius, right? Like, I mean, like, kind of like made fun of him for being social awkward and he has Asperger's, but he did this in a genius way. Like, the only thing he was really worried about was like, he knew the bonds or the mortgages, the subprime mortgages were going to go bad in about 2 years. Like he knew it. Like he knew when the interest rates were going to go up on the adjustable rate mortgages, and like he had it figured out. Like that in 2007, this is when this whole thing would start to unravel. And he just thought though, like that. But before that, the market was going to catch on and like adjust. So he was like so worried about like getting these trades in before the market caught on, and so he went through the mortgages and the mortgage bonds, the thousands of mortgages, and picked the absolute worst ones. And he was so worried, like when he like gave the list to the big banks where he's making these products and having these contracts drawn up, like that they were just going to catch on. But he's like, oh, he goes he goes talking about Goldman Sachs. Goldman Sachs emailed him a great long list of crappy mortgage bonds to choose from. This was shocking to me, actually, he says. They were all priced according to the lowest rating from one of the big three ratings agencies. He could pick from the list without alerting them to the depth of his knowledge. It was as if you could buy flood insurance on the house in the valley for the same price as flood insurance on the house on the mountaintop. So like he was just worried like, oh, they're not going to let him pick the worst mortgage bonds to buy these products for. But he's like, just time and time again, they did. They just didn't care.
Because they had no idea. Yeah,
They had no idea. And then like I love how like so and he would like play dumb. And he goes, I would play dumb quite a bit, making it seem to them like I don't really know what I'm doing. How do you do this again? Oh, where can I find that information? Or really? When they tell me something really obvious. It was one of the fringe benefits of living for so many years, essentially alienated from the world around him. He could easily believe that he was right and the world was wrong.
Yeah, and that's a common theme I think for all the characters in the book is that there's something about them that makes them kind of like an outsider that can distrust the existing system. I mean, the most like character unlike that is probably Greg Lippman, but even him has like this deep cynical distrust of the system that he's working in. And yeah, I think that's kind of the unifying theme of all of these characters. And Michael Burry, it comes from his social disposition and everything else. But yeah, they have the ability to kind of be a true contrarian to go against the grain.
Yeah, absolutely. And then finally, I mean, which brings us to our last group, which is like it's like a trio, right? And this is the group in the book, like Brad Pitt plays like this guy Ben Hockett, and there's
Mm-hmm.
Charlie Ledley and Jamie May, I think, or Mai, and like basically they just started investing their own money that they had made, like it was like $100,000, like in the early 2000s, and they would just like make really big or really small bets on things that were very unlikely to happen. But
Mm-hmm.
like, even if it was unlikely to happen, the odds they were getting were just great odds. It was like if you could bet on a horse race and there was a horse that had 10 to 1 odds of winning the race, but they could get 100 to 1 odds, to bet on it. And they went from $100,000 to like $30 million in
Yeah, very
like 2 or 3
amazing.
years. I mean, that's a little better than my returns. I don't know about you, but and then they found the pitch from Greg Lippman, and they were like, and they just got on board with it.
Yeah, and I thought they were fascinating. I really like them as investors. They basically so there's a chapter in Joel Greenblatt's book, You Can Be a Stock Market Genius, where he talks about using options as a value investor, which is like heresy for value investors. I don't use options, but anyway, Greenblatt
Right,
talks about how you
right,
do it. He's like, you find something that's like
right.
there's like a outcome that is either going to happen or not going to happen within a set time period, and he's like, that's the perfect time to use options. So they took that idea and then like, let's find a bunch of mispriced options. And then they talk about one of the interesting trades that they do is with Capital One, where like in the early 2000s people are worried Capital One's going to go out of business. They do some scuttlebutt, they go to Capital One, they talk to they got to see the CEO, And they realize Capital One's probably not going to go under. So they buy these way out of the money options and make, a ton of money on the trade. And I thought that was a super interesting approach that worked very well for them. Yeah, I thought they were amazing investors.
Yes. So the same thing. They got onto the trade like a little bit late. So like
Mm-hmm.
they at first they were like it talks about like they go to the same Vegas conference that like Eisman was at for the mortgage bond industry, and they were like, when we went to this conference, we thought we had months and months and months to get this trade like all set up. And then they leave the conference, they're like, this is happening right now. We need to get in on this like as fast as we can. But they said like basically like they were buying fire insurance like on the house, and the house was already on fire. Like, like that was how they described it. They said after this conference they realized how urgent like the situation was for them to get in on this.
Yeah, absolutely. And I think they were the only ones who really shorted like the really good, quote unquote, good mortgage bonds, which gave them this big out of the money way. And they were, yeah, and they were also Wall Street outsiders. Like to guys like us, 30 million is a ton of money. On Wall Street, it's chump change.
Right.
So they were like true outsiders, and they needed Ben Hockett to kind of get them into the system so that they could make these big bets. Yeah, so that they were also some outsiders that had an outside perspective on things.
Yeah, and so all of these guys, like they even, I guess Eisman, I mean, they had a hedge fund, they were in Manhattan, but they all saw themselves at least as outsiders. And
Mm-hmm.
and Burry and Ledley and Hockett and May, I mean, they were definitely outsiders, right? I mean, like I think like Charlie Ledley and Janie May, like it started off like in one of their garages, like when they first started trading, and then like they were just like, I mean, it sounded like they were just young 20-year-olds who they got this idea of these like these options on these like improbable odds, and just were really smart about it. Don't get me wrong. I mean, geniuses, but I mean, they were well outside Wall Street mainstream in their garage. And Michael Burry, I mean, he was outsider. And Eisman, he saw himself as the outsider. He didn't want to be part of Wall Street. And the misery. So like this is a theme that I thought we could discuss that they all
Yes.
endured. Like it almost by the end of the book, like it's almost like I don't even know if it was worth it. I mean, so they all
Yes.
get rich off of this trade, but what they had to go through to get from like point A when they made the investment to the end where it paid off for them greatly. Like I think at the end of it, they were all just exhausted, sick, and like just like kind of like I mean like over it. I mean, it's not
Yeah.
like if you and I like came upon a great stock idea and it went up 100-fold. I mean, we would just be like, like clinking the champagne glasses and celebrating and so happy. And these guys endured great misery for winning this trade. And I thought that was like a theme that it discussed pretty well for all of these people.
Yeah, it's definitely something we need to talk about with this whole situation because, yeah, they all endure terrible misery. And the reason is for years, in Michael Burry's case, he knew that these bonds were going to blow up around 2007 because he was like, okay, they're all adjustable rates. These borrowers are going to run out of money. And even if the world doesn't blow up, which I thought was a value investing margin of safety kind of way of thinking, he's like, even if my macro thesis doesn't happen, this is going to work. But for those like 2 years, 2 or 3 years, he's paying premiums on these credit default swaps, and all of his investors think he's an idiot. And you would think that in a period of time, I think he was up like 400%, and the S&P 500 was flat. They would have given him the benefit of the doubt for a couple of years, but none of his investors give him the benefit of the doubt. They
None.
all like just give him hell for 3 years. And then once it's all over, he gives up on professionally managing other people's money, and he's like, to hell with this. I want nothing to do with this because the whole experience was so incredibly stressful. And
Yeah,
I almost agree with you that it almost seems like for him it wasn't worth it. Like he probably could have built up the hedge fund to an even bigger level if he had just had a normal drawdown like everybody else in the market. That's
right.
the irony of the whole thing.
He goes, he was now undeniably miserable. And this is a quote from him. It feels like my insides are digesting themselves, he wrote to his wife in mid-September. The source of his unhappiness was, as usual, other people. The other people who bothered him the most were his own investors. And it goes on. So like his hero, the guy he looked up to the most was Joel Greenblatt,
Yeah.
right? So Joel Greenblatt kind of, I don't want to say made him, but he's the one who like took him out of like obscurity, maybe.
Give him $1 million
Like,
when
yeah,
he
gave him
had, yeah.
$100 million and said, "You're a great value investor. My fund's giving you $100 million." And so he goes, so he basically told his investors like they can't take out their money. Like so, and these contracts that he had made with the big banks, they actually had like a clause like if his capital went below a certain amount, they could terminate the contract. So for 2 years now he's been paying premiums, which is just like eating into his returns, like whatever the premiums are. But he's just waiting for the big payout. It's like in his view, it was like paying 2 years worth of like fire insurance, but the house wasn't going to catch on fire for 2 years. But you knew in 2 years the house was going to catch on fire. But like for those 2 years, if you didn't believe the house was going to catch on fire, like why are you making these payments? Like they're not worth it. And so they wanted to take out their money, but that would have terminated his contract with these big banks. So he found a clause in his like contract with his investors that they couldn't take out their money, but things just go south really quick. And he goes, immediately his partners at Gotham Capital, that's Joel Greenblatt's group, threatened to sue him. In January 2006, Gotham's creator Joel Greenblatt had gone on television to promote a book, and when asked to name his favorite value investors, he had extolled the virtues of a rare talent named Mike Burry. 10 months later, he traveled 3,000 miles with his partner to tell Mike Burry he was a liar and to pressure him into abandoning the bet Burry viewed as the single shrewdest of his career. If there was one moment I might have caved, that was it, said Burry. Joel was like a godfather to me, a partner in my firm, the guy that discovered me and backed me before anyone outside my family did. I respected him and looked up to him. Now, as Greenblatt told him, no judge in any court of law would side with his decision to side pocket what was clearly a tradable security. Whatever feelings Mike Burry had for him vanished. When Greenblatt asked him to see a list of the subprime mortgage bonds Burry had bet against, Burry refused. From Greenblatt's point of view, he had given this guy $100 million, and the guy was not only refusing to give it back, but to even talk to him. And so, like, you kind of see where Greenblatt is coming from. I mean, like, you can see both sides of the story here. Like, Greenblatt gave him a lot of money. In Greenblatt's mind, like, I think it was to, like, find value stocks.
Yes.
Right? Like, and he's, like, betting against he creates this financial instrument that didn't exist before to bet against like the mortgage market in the United States. And I think that was like Greenblatt's like, what are you doing? I want to see these bonds. And he's like, no, like basically leave me alone. And just like it spirals out of control. And he's just like at the end of it, like I'm fast forwarding to the end of the book here, but he's like, there's no triumph. Like he makes his investors all this money, but he's like, I felt no triumph. And it was just like the misery he experiences, it was really just like it's almost like a tragedy, right? Like I mean it's the book is really fun to read, at least for me, but like this part, like you feel really, really bad for Burry and what he went through and how like at the end he makes all this money, but like you just feel like, did he really win?
Yeah. And I mean, like, it's when I first read the book, like when it came out like 15 years ago or whatever, I was like, oh, how could these people miss what Burry's genius? But these days I kind of have warmed to Greenblatt's perspective, where it's kind of like you hire someone to do this job, and the job is pick stocks. And all of a sudden the guy's going out and he's doing something totally different. And I understand Greenblatt's perspective now. Like, I think I agree Burry's a genius. I agree the trade worked, but I also kind of get his point of view where he didn't like this and it wasn't what he had put his money into. And it felt scary because like, okay, I've given this guy all this money to do this thing, and now he's going kind of off the rails and he's doing this from his perspective, a macro bet. Now we both know it was not truly a macro bet, that it would have worked even if the housing market didn't collapse. But I get his point of view on it. Like, it's not what he had paid the man to do. And I think Greenblatt was owed some respect. If someone gives you $100 million, like, I don't know, you should probably
Yeah.
listen to them and be more
You give
helpful.
me $100 million, I will listen to you on how you want me to invest it. Like, I'm not
Yeah.
gonna like tell you you can't look at my research or things like that. He goes, this is like much later. So he makes a killing, right? And he gives all of the money back to his investors and all their profits. And he goes, making money was nothing like I thought it would be. And he talks about like nobody thanked him, like nobody was like thank you, like great job. He's like, I didn't hear a peep from my investors. To his founding investor, Gotham Capital, he shot off an unsolicited email that said only you're welcome. He'd already decided to kick them out of the fund and insist that they sell their stake in the business. When they asked him to suggest a price, he replied, how about you keep the tens of $1 millions you prevented me from earning for you last year, and we call it even?
Yeah. Yeah. And then that was the end of that whole relationship. And now Burry, he ever since he made a ton of money. I think he made like $100 million personally from the trade. And then he invests that personally now. I don't think he manages outside capital
Yeah, I
anymore.
don't think he does either. But if you can follow him on Scion Capital, like that's his hedge fund, and I still follow his trades. But you don't see instruments like this. But I mean, you get to see his longs, which I think are still interesting, and he's definitely not my kind of investor. Enough to take away anything from him. It's just not my style. But it's like, and it's not just, I mean, Michael Burry probably had to endure the most, but it wasn't just him. Like Eisman and his group and a lot of them too endured a lot to get through this trade.
Yeah, and it was very tough for them. I thought it was also interesting how Eisman ultimately changes for the better after the trade. So in contrast to Burry, who has this harrowing personal experience, Eisman at the end is kind of like, I'm going to be a nice guy and I'm going to stop being so abrasive and, just go with the flow a little bit more. I thought that was an interesting contrast, was Eisman versus Burry.
Absolutely. The book talks about like in the movie, Steve Eisman's brother committed suicide, but in the book, like the true story was he had actually lost a child.
Oh, it's
So
awful. Yeah,
yeah,
just
so he has
reading it,
this
it was tough.
tragic
Yeah.
backstory. And so there's obviously, I think, a lot of personal things were going on too with him. But yes, like at the end, it talks about like it seems like he overcomes a lot of his anger issues. I guess maybe it's the best way to put it. And like and and was all, at least the book painted like he was doing a lot better by the end of this. But before that, he goes, being short in 2007 and making money from it was fun because we were short the bad guys, said Steve Eisman. But
Mhm.
then in 2008, it was the entire financial system that was at risk. We were still short, but you don't want the system to crash. It's sort of like the flood's about to happen in your Noah. You're on the ark. Yeah, you're okay, but you're not happy looking out at the flood. That's not a happy moment for Noah.
Yeah, which is a great point. Yeah, and it transformed him. And I think when he was done with it, it was the last time he did. And interestingly, he's someone who is not like a lot of these guys are like, if you follow them, they aren't necessarily perma bears, but they kind of got like this perma bear cynical tendency where they're always kind of like Burry is tweeting out stuff about like how, the NASDAQ's
Right.
going to
Yes.
collapse and
Yes.
that
Yes.
sort of
Yes. Yep.
thing.
Yep.
Burry isn't like a perma bear who's just like shorting the market all the time. Burry still does great. He delivers great returns, but he still has a very jaded view of the world. Where Eisman, like I've actually listened to him on recent podcasts and things, and he's not like that anymore. He doesn't short, he doesn't predict doom. He's just kind of looking for good longs these days, from what
Oh,
I can
that's really
tell.
interesting. Yeah.
Yeah, like he's talking about like I'm investing in I forget what he was doing. It was like something with like a big theme of his is reshoring and like cloud computing, and he seems to be he's not like that. He's kind of like I made my money on the short. I'm going off into the sunset, and I'm not going to try to predict like the next big blow up of the financial system.
Well, and I mean, we're going off to the side a tangent here, but like, I do think it's like a different skill almost. Like, and I think a lot of people struggle with it. Like, if you made your money, it's a different skill in keeping it, right? Like, in like, you don't have to find the next big blow up. You did it. You made your fortune. There's no reason to like make another big bet like that again, even if you thought you were onto something. I mean, you don't have to get rich more than once, I guess. You get
Yeah.
rich once and just stay rich. That's the trick.
Yeah, absolutely. Yeah, that's the way to do it. And yeah, so that kind of gets into my next thing, which I think the long-term effects of this book and this trade is I think a lot of people keep trying to find their own big short. And I almost think that's folly. Like ever since the financial crisis, I've heard over and over again, like this is the next big short. And everybody's trying
Mm.
to find like the next big short or trying to predict the next blow up of the financial system. And it never quite works out. Like Meredith Whitney, one of the people that's talked about in the book, she predicted that like commercial real estate was going to fall apart in 2010 or something. And yeah, you just keep finding people who are like, this is a bubble, this is a bubble, this is a bubble. And yeah, like it almost seems to me like, well, maybe you shouldn't try to do that. Like that the example set in this book was a very unique set of circumstances, and it's not like a repeatable process.
Yeah, that's interesting. So I think it's hard to make money shorting.
Yeah,
I think there's like so much is I'm not saying the market's rigged. I'm just saying like it's inherent. Some of its inherent characteristics, I think, drive it to all else being equal to just go up, right?
over time. Yeah,
Over time, right? I mean, just you have a ton of passive investments pouring into the market, buying these securities, liquidity, these assets are more liquid than ever before, you know. So I think like a lot of its inherent characteristics are to like push these stocks up over time. I think it's hard to be short. I think the short sellers serve a purpose. Like I think Peter Lynch says somewhere like he doesn't get like the purpose of short sellers. But I think, look, a lot of times the short sellers are the ones rooting out fraud in companies. Like as we speak, like Hindenburg Research basically quit this week and said they're not going to do this anymore. And if you look at their batting average, I think they missed more than they hit. Like they put out a lot of short reports on companies that stocks have gone up since they put out their short reports. But they uncovered some great shorts,
yeah.
in that process, including some fraud. So, I think short sellers serve a purpose, but man, it's like it's not something I want to do. And I think it's very difficult to make money doing it. Now, let me ask you though, like, so do you think there's folly like this isn't quite the same thing, but all the time in my world, I hear this is the next Amazon, this is the next Tesla, this is the next whatever, Apple, Alphabet, whatever, right? Nvidia. Do you think there's folly in trying to find those longs too, like or trying to folly like because like all those companies obviously came from unique circumstances also. Is there do you think there's folly in trying to recreate that kind of magic too? Or do you think like you think investors should kind of stick to base hits and doubles and just try to be opportunistic, but or do you think there's value in trying to find these long shot home runs?
So first of all, I think that you're right that they are two very similar things. So in the more like cynical section of the investing world, everybody's trying to predict the next bubble. And then on the other end of the spectrum, everybody's trying to find the next Amazon.
Right.
And I think they are both very difficult things to pull off. I think maybe it's fun to try, but very difficult to find and implement. Like maybe do it with a small percentage of your capital where you're not betting the ranch on like the next Big Short or the next Amazon. I think it's fun. It's fine to do with a little bit of money, but I wouldn't make it a core of your approach. Part of the reason that moats appeal to me is that you're dealing with something that's a little bit further along in its journey as a business, but there's some characteristics that protect it from competition. And yes, you're not going to make as much money as you would if you bought Amazon at the IPO or Microsoft at the IPO, but I think you have a much more predictable outcome and you can still make decent returns. You're not going to make 25% returns, but you might do better than 10%. And that's why I personally prefer those kind of investments versus like trying to get the total like hundred bagger home runs. I think it's better to find more predictable style of
Sure.
investments. but it's fun to try. You can do it with a little bit of your
Oh,
money,
it's
but
definitely fun.
yeah, but
It's
don't,
fun when you're right, I guess.
yeah, but I wouldn't, think that you're going to find the next Amazon going around. And then I also think it's even harder than it was in the past to find those 100 baggers because just because less companies are listing. So for a lot of these companies, I think a big part of the problem is venture capital is getting the earlier stages of those returns that for like an Amazon or a Monster, you're there at the ground floor and you can invest in it as a public investor. I think they capture a lot of those early returns. So I don't think your micro cap universe where people are typically looking for 100 baggers is as good of a ground to find those things as it used to be. That's my opinion about it.
Yeah, and I think the 90s too is kind of unique because especially in retrospect, but don't get me wrong, I mean a lot of people correctly predicted this at the time, but you saw the rise of the internet and the digital economy, like basically from nothing. And I mean the tech bubble, like a lot of those people were right. They were just well, quote unquote right. They were just like 15 years early, right? Like they,
Yes.
they saw where it was going. I mean, and I think correctly. They were just early. And look, don't get me wrong. If you're as an investor wise, if you're 15 years early, you're wrong, right?
Yes.
Like that, you're wrong. But like I think a lot of their predictions came true. Just like there's a reckoning in the meantime there. But I don't know, even with AI and things like that. Like I don't know if you're gonna have that kind of like complete business ecosystem of like just like or explosion of innovation that came from the internet and e-commerce and the digital world, right? Like personal computing, mobile technology, I mean everything, right? I just don't know if you're going to have those circumstances again where you're going to have a lot of companies like Apple, Amazon, Microsoft to rise from that ground floor.
Yeah, totally. And if you had a diversified portfolio of internet companies in the 90s, I mean, it didn't work out that well. I mean, you could go for like the big names like Intel and Cisco. Well, they were dead money for 10 years. Intel hasn't performed that well. Cisco, dead money for 10 years. It's done like market style returns over, I think, the last 10. You have all these companies that just burned out, like, the pets.com. And then there were other like I remember JDS Uniphase was a big one back then. And you could have picked this diamond in the rough, which was Amazon. But, are you going to do that? Are you going to hold through a 90% drawdown? Even if you bought like QQQ as like, I'm going to own tech
Right.
because that's the future. Well, you had an 80% drawdown in the early 2000s, and then it was dead money for like 15 years. That's not a great outcome. And then also think about it in the sense that the big winners of the internet, a lot of them weren't even public in the 90s. So you've got like Netflix. That didn't go public, I think, until early 2000s, like during the
Oh
tech
yeah,
crash.
Alphabet wasn't around,
Yeah.
Facebook, yeah, a lot of these players were definitely not around.
Yeah. Google, they didn't go public till '04. Yeah. I think Facebook didn't go public until 2013. Microsoft was around, but Microsoft also had a terrible 12 years from 2000 through about 2012. So yeah, I think it's hard when you're looking at a brand new industry to say like, here's who the winners are going to be. Like it's very
Yeah.
difficult
And then
to
to try to
know
recreate
that.
that magic when there is no, or maybe not a new industry quite like that.
Yeah,
But
so like AI is probably the equivalent of that today. Right now, everybody's piling into NVIDIA as okay, they're making most of the GPUs that are running these AI devices. There's going to be all this capital spent on it, but that could go sideways too. I mean, you could have had a very similar thesis about like fiber optic cables in the late 90s. We built all these fiber optic cables, which we eventually used like 15 years later, but
right.
it all looked like capital wasted for about 10 years or so. You could have looked at Cisco. It's like, okay, the internet's a big thing. Here's these guys making the modems that everybody needs to use and the servers that everybody needs to use. And that seems like a safe bet. It was not a safe bet. And Intel went through similar trouble. So, yeah, I mean, it's easy to say like AI is the future, NVIDIA is the company that I'm going to go with, but I'm sure in 20 years we'll be saying like the best investments from AI is probably something we don't even know about right now, would be my
Sure.
guess.
Sure.
All right. Well, yeah, I mean, this was an awesome discussion. Anything more you want to discuss with The Big Short? Any
No, I
other
mean, I love the
themes?
book, but I mean, it's a great story. Like, I mean, I think you have the several different aspects that appeal to me. Like, it's a great investment, and I love hearing great investment stories. It's probably the largest like financial market crash like I've experienced in my lifetime. It's certainly as an adult. So it's a great like behind the scenes look at that from, just from that perspective. I mean, I enjoyed the book immensely. It was good reading.
Yeah, totally. Yeah. So, I mean, if you haven't read if you're listening and you haven't read The Big Short, definitely recommend that you check out the book. So, before we wrap up, so what are you currently working on these days? What would you like to promote on this podcast?
But you can always find me on X at the Matt Cochrane, and I am at longtermmindset.co, just writing like educational articles, and they put out classes on valuation and how to read financial documents, and so when you read a cash flow statement, like what red flags are you looking for? What are good signs and things like that. I think it's geared more towards like trying to teach investors how to fish instead of giving them like serving up stock recommendations or giving a fish a day. So we do put out a lot of educational content, longtermmindset.co.
Awesome. Well, thank you for your time today.
Thank you for having me.
Thank you for listening to today's podcast. For more information, please go to securityanalysis.org. Subscribers to the website get early ad-free access to podcast episodes in addition to weekly in-depth profiles of companies.